Yes.
Okay. Top of the morning to all of you. The financial markets have been in constant state of upheaval lately. Our invited speaker tomorrow, David Dietze, that is today, will help us make sense of what's been going on. His colleague, Fritz Schoenhut, will join him. David Dietze is a managing principal, senior portfolio manager, and founder of Peapack Private Wealth Management, formerly Point View Wealth Management. He has spoken to Olgard twice before. He and Fritz will assess the outlook for markets in 2021. How will the new Biden administration affect the economy and the markets? How should you best position your investments amid the COVID-19 vaccine rollout? What potential tax changes may occur, and how might they affect your income? We hope all of you can make it. So David and Fritz, take it away, please.
Hey, Jay, thank you so much for that warm introduction here. So delighted to be back for my third time in front of the Summit Old Guard. First time was in 2007. And, I just love the questions and Q&A. We're going to have that at the end of this presentation. So save them. I think you'll have a chance to give us your questions live, or of course you can always filter them into the chat box and we'll read them out loud if you prefer. We were back here a couple years ago, and again, it's always a great experience, a great honor. So thank you for having us back. Our format here is yours truly is going to handle the first part. Then I'm going to turn it over to my esteemed colleague, Fritz, who's formerly from Goldman Sachs, now lives in Berkeley Heights. You're not going to be able to recruit him for many, perhaps years, because he just had a newborn, so he's a busy guy. But we're both looking forward to talking with you. So Fritz has got the screen. Next slide, please, Fritz. So, for those who are not familiar with us, just going to talk a little bit about who we are, what we do. Why is that so important? Because there's so many people in the financial services business, but everyone approaches it from a slightly different angle. And if one joke kind of comes to mind, it's like whenever you ask your barber if you need a haircut, they tell you yes, you need a haircut. So you always have to know where someone's coming from. Well, physically, we're coming from Summit, New Jersey. I grew up in Mountain Lakes, but for the last, let's say 27 years have been in Summit, right on Springfield Avenue, opposite Peppercorn. Come by and visit us when, of course, it's safe to do so. So we are basically registered investment advisors historically, and always adhere to the highest fiduciary standards. It's all about putting the client first and doing what's right. That's what keeps me interested in this game, and that's how I think it should be done. So by way of background, September 1 of 2019, as Claire and I, who is my wife, who's a tax attorney, who's in business with us as a financial planner, started saying, gee, what is the next transition stage? And at the same time, Peapack Private came to us and wanted to incorporate us into their $8 billion under management as part of Peapack Gladstone Bank. So basically, we sold the business to them, but agreed to continue working with them for a number of years to make sure that there is a seamless transition, and to make sure that at the end of the day, there would never be a situation where our clients weren't taken care of. Well, why Peapack? One of the things is, of course, they have a great number of investment professionals down the road over in Bedminster, New Jersey, throughout New Jersey, really. So we have more resources if we need them. We also can help pay attention to the debt side of the clients' nest eggs, if they need a loan, mortgage, refi, all that kind of good stuff. And also, so many people now are using trust. We always tell people, get a family member to serve as trustee. No one cares about you like a family member, and no one does it for a better price than a family member. But unfortunately, there are situations that often involve special needs situations where there is not a family member who can do that, in which case Peapack has a great trust service, both in New Jersey and also in Delaware for tax reasons. So what exactly do? We really do two things. One is we manage people's portfolios. We take their nest egg and we review it, we restructure it, we manage it for the long haul. But we also take care of anything that's a financial question, whether it's estate planning, funding for kids or grandkids' education, fixing up people's mortgages and so forth, establishing trusts, how to pay for a car. If it's a financial question, we hope to be the first call. We want to serve as a CFO for families. Now, we're not just about making raw returns. We're very proud of what we've accomplished over the last 27 years. But, you know, particularly given that 98% of our clients are private, which means taxable clients, it's not what you make, it's what you make after paying Uncle Sam and, of course, Trenton as well. And, of course, one way that we do part company big time with the competition is we believe in using individual stocks and bonds. Most people who do what we do, they say, great, we'll manage your portfolio. And all of a sudden, they turn it over to third parties who are running funds and so forth. I analogize a little bit to someone inviting you over for dinner and then bringing in to take out food and asking you to share the bill. Doesn't work for us. $1 million relationship minimum, 1% fee, which includes not just the investment management, but also unlimited financial planning, unlimited meetings. And of course, we do save because instead of putting clients into third-party funds and having fees that they've got to pay via that, we sidestep all of that. Next. So, you know, we want to give you our best views as to what the future might hold, but let's just see, where are we today? Quite frankly, it's been an unbelievable market since the pandemic lows, March 23rd. You've got the NASDAQ and smaller stocks up, they've nearly doubled, okay? And with the Dow and the S&P 500 up close to 60% over the last year. This year has started off strong, particularly for cyclical and value stocks and smaller companies. You get that S&P mid-cap is already up nearly 15% so far this year. The Dow is finally outpacing its S&P and NASDAQ brethren, up over 7%. You got 5% the S&P 500. NASDAQ has lagged as there's been a bit of a rotation from so-called growth stocks that are pricier but perhaps have better and faster outlooks ahead of them, to value stocks. Those are stocks that have lower priciness but perhaps more muted outlooks, higher dividends and stuff like that. You'll notice dividend yields, they are low. They're some of the lowest in history on the S&P 500, only 1.47. Just for a long time, that was higher than the 10-year Treasury, which you can see down below at 1.63%. Now the 10-year Treasury has crept up above it. Historically, 10-year Treasury has yielded more, and the reason you would accept a lower dividend yield on a stock is because that payout should be growing over time. Hopefully that 1.47% today is double that 10 years from now, while that 10-year Treasury is going to be locked in at 1.63 if you should buy that today. Dollar weakness all last year was not well covered. This year has perked up just a little bit. That is perhaps due to the fact that our interest rates have moved up. So a lot of people are bringing money to this country to take advantage of the higher yields, higher than, for example, the Japanese yen's 10-year Treasury or euro dollar rates and so forth. Plus, of course, the perception here, and I think it's the reality, that our pandemic response has improved, which is going to make for a sturdier economy and therefore less money printing, less deficit spending required. By the way, the NASDAQ is technically in a correction. A week ago, Monday, it fell more than 10% from a recent high. And it was very rare because the Dow was hitting an all-time high where the NASDAQ was in correction. We haven't seen that since the late 1990s. And you know, the way the the lore works is that you're not out of a correction until you set a brand new high. So NASDAQ even though it's done well the last couple of days, still that correction. Some people say you're out of the correction if you go up 10% from that low point. We'll see. So interesting developments this year so far. Next page. So, it's always good to put everything in context. And quite frankly, it's been a fabulous last 20 years. And here's a chart that shows that. But what's interesting here, if you look at the first 10 years, now this is the S&P 500, first 10 years, basically, you didn't move in the S&P 500. If you think back, just about a decade ago was when everyone said, oh, well, we need alternatives, we need to do more emerging markets, we need more commodities, we need more hedge funds, we need everything but Travelers or J&J, which have not moved for a decade. We've got to do something more exciting. Of course, at that point, when everyone moved to that side of the boat, the S&P 500 became much better valued. And of course, about a decade ago, you can see how that line started moving north. So, so the good news is we've had a good 20 years, but it's all been in the last 10 years, the second half of the basketball game. I guess if there's a cautionary note is if you study economic history, sometimes these big trends last about 10 years. So now the question is with all-time high valuations and interest rates perhaps starting to move north, what do the next 10 years hold? Certainly, it's not going to be as good, in my view, as the last 10 years. Also interesting, you can see that pandemic spike in the beginning of 2020. You can see how sharp down it was and what a sharp comeback it was. Next. So, what did we learn looking back here that may give some clues as to what we can expect going forward? One of the things that was interesting here was the fastest bear market on record as people, policymakers, countries around the earth went into a panic with the prospects for the devastation, which in fact was for the most part realized in terms of physicality with the COVID-19 spread. However, it was also one of the fastest recoveries on record, and that was due to, quite frankly, a miraculous response by both the Federal Reserve, our monetary policymakers, and by our government in terms of fiscal policy. And it really stands in contrast, I think, with what we saw in the subprime crisis, because there they moved a little bit more slowly, and it took us a lot longer to get out of it. So why the difference? I think two things. One is, if you remember back to the subprime crisis, there were good guys and bad guys. Who were the bad guys? The bad guys are the people on Wall Street who told us we would never see a national downturn in real estate, who bought off all these mortgages and sliced and diced it so that many slices of the mortgage packages were actually toxic in terms of their lack of any kind of buffer in case real estate prices went down. And so I think the Federal Reserve was cautious because did they want to bail out Lehman or not? Was Lehman worth bailing out, or should they kind of stew in their own juices? Well, by hesitating, they made things worse. Maybe, from a moral or ethical perspective, it was appropriate, but that was the big difference. Well, in this downturn, there were no bad guys. It was like an alien force. No one was responsible or the cause of the virus. And so therefore, no American business, no American small business should be left behind because of something that had none of their doing, which was the COVID virus. So we saw that extraordinary response by the Federal Reserve, shoring up all sorts of weak spots in credit markets, lowering interest rates to zero. It was a war. And of course, the other thing that was a big savior here was that we had the 2009, 2008 Federal Reserve playbook, which was to not just lower interest rates, but basically open up the checkbook and start buying credit instruments, the so-called quantitative easing. So you're able to dust off that playbook and use it to great effect very quickly. And so people, our clients were like, well, Dave, how can we stay invested because of what's happening in the implications. And basically what you really had to do was not to underestimate the power of monetary and fiscal policy to basically right that ship and start writing big checks and get things going on. The other thing that was interesting, and of course the fiscal side, the same deal, we've seen now 6 stimulus packages, and the willingness to cut checks and to basically using something that Ben Bernanke analogized to dropping money out of helicopters on the American people to great effect. And that too helped bridge this gap between, having this terrible pandemic and then ultimately getting to the other side with hopefully vaccines here. One interesting thing, a lot of print, a lot of websites focused on the election, but at the end of the day, it really had little effect. And that's one thing to keep in mind, is that people spend a lot of time and they often put their political partisanship on their sleeve. And that's great cocktail talk, but once you start trying to manage your portfolio around it, you get lost real quick. And basically, you can talk about the American flag, you can talk about politics, but at the end of the day, most Americans want a strong economy. And so that is always something to keep in mind before one minimizes the potential performance or approach of the other side. And of course, the other thing is that in the unique situation that our founding fathers created for our government, with nothing getting passed until basically is approved by the president and both houses of Congress and potentially subject to review by the Supreme Court, little action is usually the end result. We call it gridlock. And quite frankly, the financial markets, the economy likes rules that don't change constantly. And so that's another saving effect as to why you shouldn't bail on your portfolio because of developments in the market. It was kind of a tale of two markets insofar as growth stocks whipped value stocks, but the tide has kind of turned since September, with value stocks outperforming by about 20%. Large caps did best. They were seen as strongest, but after we saw light at the end of the tunnel in terms of the amount of the stimulus and in terms of the potential for vaccines, the small stocks really took off. And so if there is some takeaways, don't try and time the market. The only way you lost last year from an investment perspective is to move to the sidelines and wait till the uncertainties cleared up. That was the only way you lost. If you had the guts, you rebalanced when that S&P 500 was down 35% by March 23rd and got back to your long-term asset allocations. And of course, not to underestimate the power of monetary and fiscal policy. And of course, don't get too carried away with the elections in terms of managing the portfolio. Remember, you should have a multi-decade, perhaps, view on your portfolio. So, presidents come and go every 4 years. Don't get too carried away. Next. So what's our market outlook? Well, it's not going to be as good as it was in the last year. It's just impossible mathematically. But we are positive. Basically, we're on the cusp of the strongest economy in 35 years with the latest stimulus package. Economists are looking for about a 6% crank up in GDP. It could be as much as 8%. We don't know. And it's going to be worldwide as all countries are going through the same reemergence because of the success here, apparently in the rapid vaccination, plus the continued support by policymakers. We still got the very low interest rates, which are incenting people to get into real estate and stocks. As I said, the economy is going to drive corporate earnings, but there are several risk factors which we're going to analyze just a little bit here, including higher interest rates, inflation, an unruly virus, and excessive speculation that we see. Next. So number one driver here in terms of the success going forward here is the vaccines. We've got 3 approved, more are on the way. Novavax and AstraZeneca may yet be approved in this country despite some disappointing results in Europe. Believe it or not, 1 in 5 adults now has already taken the vaccine. 1 in 10 has both, which with the Moderna and Pfizer should mean that you got a 95% safety net. So, that's just great news. And every day we're seeing more engagement in the economy. The TSA, who runs the airport security, said on Friday we had the biggest day of air travel that we've seen since the pandemic started. Also, here in New Jersey, of course, they're expanding the capacity limits for restaurants and so forth. And of course, we've got an administration here. President Biden knows that he's going to be judged in terms of getting off the ground, in terms of his administration is getting this virus under control. His focus is to have all Americans eligible to get a vaccine by May 1 and a somewhat normal July 4th. Don't we all hope for that? Next. Low interest rates, second bullish factor. The fact of the matter is, people are worried we're at 1.6, could go to 1.8, could it go to 2. Even if it was 3%, most people cannot make their long-term retirement goals by just earning 3% of their portfolio, because 3% on your portfolio and maybe up to 3% inflation means you got 0 real return. So as a result, there's going to be this continued wall of cash, in my view, into more creative assets than cash, CDs, bank accounts, and so forth. So I think that's very bullish. The Fed has promised that they're going to keep interest rates low for longer as they target very low unemployment levels and not worry as much as they have in the past for inflation. Over on the other side of the pond, the ECB has doubled down. That ECB is the European equivalent of the Federal Reserve. They've actually started to increase asset purchases as yields have gone up to try and counter that. TINA still prevails. So the question that I just saw in the chat, what is TINA? TINA quite simply means there is no alternative, meaning you gotta be in stocks or real assets as opposed to bonds. Also, the steepening yield curve is a big positive. What does that mean? It means the gap between very short-term rates and longer rates has gone up. If it flattens or goes negative, that often foreshadows a recession. Now it's very, very positive, which means banks can pay you, if you keep your money in banks, very little, and then lend it out in mortgages or other loans and make a big profit spread. And that's seen as a harbinger of good news ahead. Next. Fiscal stimulus. We've never seen the wall of cash that is coming. We've just got that $1.9 trillion stimulus package. What's it going to do? Well, I just chatted with my son who finished college in June and has a job. He's actually working for Fidelity Investment himself, and he told me the stocks he's going to buy with this $1,400 check. So it's going to go into consumer purchases. It's also going to be used to pay down debt, and a large portion is going to go right into the stock market. Unfortunately, maybe Bitcoins and other cryptos. We'll get to that, but it's going to add about 3% to the GDP. And there may well be a huge multi-trillion-dollar infrastructure that package that follows up the latest stimulus. So you've got the government spending with abandon, without at this point trying to raise taxes. That's a very bullish development. Next. So corporate earnings. At the end of the day, the only reason you spend money for a stock is you're going to get money back in terms of what that company can earn with its business activities. And we're going to see earnings up, let's say 20% this year versus last year, and another 10% in 2020. Now, interestingly, it's not all going to be equally doled out in terms of various sectors. Financial services should be up 70%. Of course, they weren't making any money at all as they were writing off their loans or putting them into the potential loss category. And consumer discretionary, as the consumer opens up their wallet and gets out of the house, could be up 4%, 40%. Traditional growth areas going to be a little bit more muted because they weren't down as much. So big cap technology up about 10%, and healthcare only up 2%. Well, why? Because basically, a faster growing economy and being able to get out of the house doesn't necessarily mean you want to spend a lot of time in the doctor's office. So only up 2%. But remember, a lot of the good news is priced in, and always investors don't really care what you made for them last quarter. They want to know, what are you going to make for me next quarter? So you always got to pay attention to that all important outlook when those earnings are released. Next. Economy. As we've talked about, this economy is going to bounce big. Interestingly enough, there's a big disparity in terms of the forecast. On the low range is the Federal Reserve, who's forecasting just a 4.2% increase. Of course, they're trying to make the case that they continue to need to keep their feet on the gas in terms of quantitative easing and keeping interest rates very low. So it'd be a little inconsistent with that for them to have a big number on the potential GDP growth year. Of course, they are getting ready to meet today for a 2-day conference. At the end of that, they're going to talk about what their action is, and they're not going to really change their base rate level or exactly what they're doing, but they're going to talk a little bit about the outlook. And so what's going to be very interesting is they're going to probably increase their forecast for the economy. And it's going to be a very careful dance that they're going to have to do, because if they get too bullish on that, then people are going to say, oh, you're going to end the monetary stimulus, maybe interest rates should go up higher. But if they're too cautious relative to what the private sector is saying, they're going to lose a little credibility, and people are going to say, well, you've identified a concern, but you've got no more tools that you're willing to use to solve it. So it's a very tricky thing that they're going to have to do, and we're going to learn more tomorrow afternoon. Job creation improving, unemployment claims slowly declining. Now, today we had a very bad number on retail sales, but if you look at it closely, January retail sales were up big time, and we all know that the weather was absolutely terrible. Obviously, it's not good in the Northeast, but nothing compared to how bad it was down in Texas and the south central part of the country. So we think that is an aberration and a one-off, and of course, everyone's going to be getting the stimulus checks next. So, but there are risks. One is, if getting past the virus, as Janet Yellen said, there's no stimulus like a receding pandemic. So that's really the most important thing to focus on if you're trying to divine the tea leaves in terms of where we're going here. But there are the risks. I think the biggest one is the mutations. And so we've got the vaccine, but will the vaccine work against all mutations? We're not quite sure about that. They're doing a lot of studies. But to the extent that the virus changes and we don't have a vaccine, we're back to where we started. So that's risk number one under the vaccine category. Of course, there's still substantial resistance to taking the vaccine. Very sad, but it's out there. And so in order to get to herd immunity, we need a certain percentage of the American population to take that vaccine. Unfortunately, vaccine rates overseas are much lower. In Europe, they didn't want the Pfizer vaccine because they didn't want to pay for it. Now they got a problem with the AstraZeneca one. Their rollout has been very challenged. And so, it's a global economy to the extent that they're not doing so well. That ultimately hurts us. It's a potential source for reimportation. The Asians actually had a better pandemic experience, but as a result, they're less far along on the vaccine too, because it hasn't been quite as bad a problem as in the United States and Europe. And of course, the other question is, I talk with my clients, well, now you've gotten the 2 jabs, what are you going to do? Well, Dave, I'll tell you what we're not going to do. We're not going to go to a bar. We're not going to go to a crowded restaurant. We're not necessarily going to get on an airplane. In fact, the CDC says maybe you shouldn't fly even if you've been vaccinated. So that's another question that investors need to look at. Once we've got the vaccine, will Americans really fully engage or what? Next. So higher interest rates are a big threat here. So Jerome Powell of the Federal Reserve said he's going to keep interest rates low and allow inflation to run hotter. But, ultimately, it's not his money. It's the bond investors' money. Did he check with them? Are you, as a bond investor or any bond investors out there, willing to continue just to accept lower rates, even though inflation is higher? I don't know about that. So, that's the concern. And we've already seen a big jump in interest rates just this year. We were under 1% on on the 10-year treasury when the year started, and now we're about 1.6%. Well, if that keeps going every 2.5 months, we get a big problem before the end of the year. And remember, we talk about getting back to normal. Well, at a certain point in 2019, interest rates are at 2.8%. So if we're really going to get back to normal, you probably have to expect something well into the twos. And of course, real interest rates. What's that mean? That means what you get in a 10-year treasury versus inflation. 1.6 in the treasury, 2.2% in inflation. That means real interest rates are negative, and that seems inconsistent with a better economy. And of course, the government's going to have to pay for this 1.9 trillion. They're not going to tax us, so they got to borrow to pay for it. So they could be pushing rates up too. So I think higher interest rates could have a big effect on the market. It reduces the present value of all assets, houses, businesses, stocks, but there could be a difference in the effect, so that stocks that are growth stocks, which have less in the way of current earnings, but more earnings way down the pipe, they could have the same adverse effect compared to a very long dated bond. Remember, a 30-year bond takes a big hit when interest rates go up versus a 2-year bond, which takes less of a hit because you're going to get your money back in 2 years, not 30 years. Next. So inflation linked to interest rates, but if there's $1,400 checks distributed, the economy picks up, people start buying, demand could exceed supply, and the only way we resolve that is prices go up. Remember, the supply of dollars just over the last 9 months up 25%. Now, what you have to, as an investor, to assess is once inflation starts going up, a lot of people are going to say, oh, not to worry. It's a tough year-over-year comparison once we get to in the fall, when comparisons are versus, more reasonable energy prices, it won't look so bad. And you have to assess whether that, in fact, is the case. Other people are going to say, well, it's a supply disruption, price is up, but, there's problems with the container ports, there's ships offshore, and once that resolves itself, prices will moderate. Maybe not. The Fed has said they're going to be willing to tolerate higher inflation because inflation has been low for so long, and to try and achieve their superior employment levels. But, will bond investors sit tight? We're going to see. And we know we've already been seeing inflation in commodities and financial markets. Of course, against that is these long-term trends that have kept inflation down a little bit. Aging population spends a little bit less. Productivity from new tech tools allows us to keep costs down. And of course, as soon as prices pop up here, we figure out a way to import it from overseas, and that's helped inflation stay low. Next. Valuations. We can't sugarcoat this. This is an expensive market, period. 22 times this year's earnings, 20 times next year's earnings. The only way you can justify that is say, well, it's less expensive than the fixed income market, and I can't make my endowment distributions. I can't take make my retirement withdrawals with the expensive nature of bonds, which means the interest is so low. So that's the only way you can justify it. In fact, by some metrics, this is the most expensive market we've ever seen. So if you, obviously, a lot of people look at price to earnings, but if you look at price to sales, this is more expensive today than it was in the dot-com era. Warren Buffett likes to measure priciness in terms of the market by looking at the total value of all stocks compared with the total value of the US economy as measured by GDP. Once the stocks get over the GDP, he starts listing it as expensive. And right now, that metric is much higher than it was even in the dot-com era. Another way you can rationalize it, though, is a lot of the priciness is just in those 10 stocks. Tesla leads the brigade. And so if you strip out those top 10 stocks, which are 30% of the market, prices become more reasonable. So if there's a takeaway, it's, don't go where the priciness is, but look at something below those top 10 stocks. Next. Another thing that I worry about is we've got a lot of speculators out there. Unfortunately, when the public, remember the stories of the the harbinger of the stock market crash in 1929, was it Rockefeller or someone like that, said, when the shoe shine boys start telling me what stocks to buy, I'm out of this market. Well, we kind of have a present day thing going on with people on social media websites throwing money into stocks in ways that just don't make any sense at all. The Reddit trade, as they call it, and that's certainly a red flag. You know, sometimes it's justified. Well, no one has anything to do because they're all sitting at home, so they want to trade stocks. They can't spend it on other stuff, so they might as well put it into stocks. But it's not a positive. And of course, the intense interest in SPACs, IPOs, and cryptocurrencies is disconcerting. Every market top has its things, you know, it's, you know, high price for tulip type of thing. And that's what we're seeing now. And that's a cautionary sign. Next. You know, we were doing so well just over the weekend. The administration is talking about higher taxes. I really think that's very interesting because Jerome Powell, the Federal Reserve, is trying to stimulate the economy. We just passed $1.9 trillion stimulated package. And quite frankly, when the government starts raising taxes, that's a negative for the economy. Now, you can justify it for other reasons, but it's very tricky to start blowing in the other way before we're totally out of the recessionary conditions. The biggest concern, I think, is higher corporate taxes. Now, put into context, they were 35% coming into the last administration. Trump got a law that passed it and to bring it down to 21%. The potential change on the table is to go halfway back to take corporate tax rates up to 28%, but that would be 1/3 more in taxes, and that's not insignificant. And then we're going to have the problem of companies going overseas and so forth. I don't think it's a slam dunk because we have such a divided Congress today. And quite frankly, although everyone's for stimulus, even if your neighbor's going to be taxed and not you, for the most part, the American people don't like higher taxes. They're nervous about that. And of course, that's totally inconsistent with what the Federal Reserve is doing. You know, Jerome Powell said, well, you told me to keep interest rates down to give this economy a chance. And now you're undoing this by imposing heavy taxes, big tax increases. So we'll see what happens, but it's something to watch. Next slide, please. And of course, it's not just on the corporate level. President seeks to raise income tax on high earners. Under some formulations, if you're making more than $1 million, there will be no lower rate on capital gains taxes. Obviously, that's going to make stocks, and for that matter, real estate and other assets less attractive. Perhaps raise the top rate on high earners, those making more than 400,000 from 37 back up to, you know, close to 40. Dividends may not get a special break. All that will be a negative. I don't think as much of a negative as higher corporate taxes, but something to watch carefully. But again, given we're not really totally out of the woods in terms of the economy, or for that matter, the pandemic, given the very sharp divide in terms of Congress, and given the natural reticence on the part of the American people to accept larger taxes. Remember, we haven't had a big tax increase since 1993. I'm not too worried about it this year. And next year, we're in the countdown to the midterm elections. And again, no one wants to be running after they just told people they raised taxes. So it's going to be interesting. At this point, I want to turn the baton over to my esteemed colleague, Fritz Schoenhut, to tell you how to make some money here. Fritz,
thank you, David. So I'll move through this a little bit quickly because we do want to get through. I see a lot of questions coming in, but I don't want to sacrifice any of the content or the quality of it. But you know, we are saving some time for questions at the end. So this brings us to, where there are opportunities, and we see opportunities in the market in the reopening trade, in the cyclical and dividend paying stocks. We see opportunities where there's, inflation hedges, and then, specifically some opportunities in financials, defense companies, utilities, and big pharma. So the reopening trade, and so a lot of the companies that have been doing really well since the announcement that the first Pfizer vaccine was successful have been those companies that are more tilted or more exposed to the reopening trade. This kind of coming out of your shelter in place, coming out of the quarantine, and the regrowth, the rebroadening of the economy. And so, the casino and gaming stocks, travel and leisure, restaurants, hotels, live music and sports, and then, some consumer staples and the airlines as well. We've seen that, people are, as people are more comfortable, kind of getting out of their house, more comfortable, getting more engaged in the economy and going on those trips, going out to dinner, that's really benefiting, a large portion of the market that was really kind of left behind in 2020. So cyclical stocks are those that are more aligned with the broader economy, and as the economy is doing better, these stocks typically do better as well. And so here we're talking about the energies, the energy stocks, the materials and industrials. They can be a bit more volatile. Last year was definitely a difficult year as they are more sensitive to economic changes. But as the sentiment around where we're headed coming out of the coronavirus pandemic, these stocks have really taken hold and have really been bumped up since November, specifically energy, which was really hit hard last year as people stopped traveling. We all know about the business travel, but really, the leisure travel, a lot of the shipping and things that were kind of put on hold that use a lot of energy, a lot of the oil and gas. Now that the economy is moving again and starting the gears of the economy are moving. We're seeing the demand on energy increase, which you're seeing the price of oil move up, and that's certainly helping the producers and manufacturers there. So financials, right after energy, financials have been, the second leading sector since November, and they are a big beneficiary of higher interest rates. So, if there's concerns about, where rates are headed and how a rising interest rate environment might, hurt, the broader economy as we're seeing, sorry, not economy, the market with valuations. Well, financials have been an area that, can take advantage of those higher interest rates. Not only does this interest rate environment import an improving economy, but that improving economy typically means that the quality of loans that the banks are offering are better, and there's also more loan demand. As companies' balance sheets kind of repair themselves, and as they look more for growth in this expanding economy or re-expanding economy, that loan demand drives the revenues for banks. Additionally, as interest rates rise, you have this steepening of the yield curve, and there's the net interest rate margin, which is essentially the difference between what banks can charge on loan products and then what they're paying, on their savings account. And as we all know, your savings account's probably getting 1 to 5 basis points. And so, the spread that they can charge, or the spread that they can make there as interest rates rise expands, and that hits their bottom line. So it's good from an earnings perspective. And they're still trading at pretty low multiples of book value. So we think that there's plenty of opportunities here, both in the larger cap banks like JP Morgan, Bank of America, till some of the more regional, smaller banks like Comerica and KeyBank. Healthcare stocks. So we believe that these are attractive. They are traditionally under pressure around election time, and that's really what we saw. And there's a lot of concerns with kind of where we're going in terms of, health insurance and where the healthcare industry is headed. There's thinking of ways of how we can reduce costs, maybe move to a single payer system, and the price controls we put on the companies, and if they have permission to re-import drugs and or the pricing power that Medicare is able to exercise. And so there's a lot of negatives that the healthcare companies are facing, both politically and regulatory. However, kind of coming through the pandemic and through the coronavirus, there's this new respect for the major healthcare companies. Pfizer, having come out with a vaccine, Johnson and Johnson, and their role really in fighting this virus. And additionally, Joe Biden, having been the successful Democratic candidate and now president, kind of tells us that there's, the more progressive side of the Democratic Party, had not prevailed, or really, it could be more of a moderate approach to any, healthcare, landscape change. And lastly, we would just also mention, Warren Buffett, his Berkshire Hathaway has announced major stakes in Pfizer and Merck and AbbVie. And as someone who, many, long-term investors look to for investment guidance, there is some kind of a feeling of a safety net there, with some major positions in those major companies. So defense stocks like Lockheed Martin and Northrop Grumman, historically they cheapen in anticipation of any Democratic policies, but then they revert. And so we've seen that, really since over the past 6 months since the election, where Lockheed Martin and Northrop Grumman have actually declined about, on average, about 10% each since then. And we think that this is a good way to kind of get exposure to, some undervalued areas of the market, but also get exposure to some great tech companies as well. They do have exposure to this kind of very high growth area of the market, which is the satellites that you're seeing Elon Musk and other major entrepreneurs tout. But these companies tend to be a bit more counter-cyclical. So it's a good way to stay diversified in a very, cyclical heavy environment right now. Like I said, they do have some low valuations that are attractive. Boeing, especially, they're up about 60%, I think, over the past 6 months, but still, relatively, decently valued and certainly, had overcome a lot of the issues with their 737 MAX. And one of the reasons why we like these companies as well is because they have very long life projects, and so they can tend to be a bit more stable. And they also have very strong overseas sales, and so that's something that many people often overlook. So, there's a lot of opportunities out there, but, with a very strong market, and, as David pointed, it's a kind of a frothy market. There's a lot of speculative areas as well. And these are some things that in our view are areas to avoid. So the cryptocurrencies, the SPACs and IPOs, and then the pandemic darlings. So cryptocurrencies, our take is really to keep the bat on your shoulder. It's been hard watching Bitcoin rise from about, the low of last year was around $4,000 to around 54,000, 55,000 today. But it's an asset class that is very young, and Bitcoin itself is difficult to value. What is the fundamental value? Why is it worth 55,000 versus 5,000? And it appears to be just based on what someone else is willing to pay, but there's no earnings to it. It is very exposed to the potential for hacking. It's a purely digital commodity essentially that I think a lot of the exchanges that it's traded on are not as secure as the Fidelities out there and the E-Trades. You're also seeing more governments kind of come out with either outright bans, like just this past weekend India came out and was seeking to potentially ban holding any cryptocurrencies, and that had a big hit to the price of Bitcoin. And regulation, Janet Yellen is not too sure here in the U.S. Kind of what Bitcoin is or how it plays into kind of where we're going as a financial market, but there seems to definitely be a desire to have some sort of regulatory body overseeing it. And which will be the survivor? Bitcoin was first to market, and it has certainly grown to be the biggest cryptocurrency. But there's really no moat, or there's nothing stopping from another currency kind of coming in and taking its place. And then lastly, as people turn more towards ESG investing and are really concerned with the carbon footprint of the companies that they're investing in, Bitcoin is known for not being green at all. It uses up a lot of energy to mine a single Bitcoin, and so we think that there's a lot of there's a lot of potential, but there's also a lot of question marks out there. And so, in our view, it's better to stay away and keep the bat on your shoulder, as we say. SPACs and IPOs. So SPACs are special purpose acquisition companies, and essentially they are these blank check companies. And so investors, they're created by seasoned executives, management executives, former CEOs, CFOs, entrepreneurs that have a history of operating companies successfully. And so what they do is they say, hey, we're going to start this company. We're going to issue shares for $10 a share is what typically they go for. And so we'll have all of this cash, and we'll take 2 years to find a company and take it public and manage it. And essentially, as an investor, you're putting money into this pot and just hoping that they find a target or a merger or acquisition and are successful in pricing it correctly and taking it to market and running it forward successfully. And so what you're investing in currently doesn't have any revenues or profits, but they also don't have a clear target. They just have industries and areas of the market that they want to focus on and what kind of companies they're looking for. But typically there's no set company that they are going into market with. So it is a huge leap of faith. IPOs, on the other end, tend to be more what we're seeing is unseasoned companies without long established track records, many of them with negative earnings, and really just cling to their high growth and growth potential. And so what we see is these IPOs and SPACs are more often correlated with late stages of a bull market. In terms of the IPOs, you can think back to 2000, 2001. It is concerning that you're seeing these how these are being priced and the demand for them without any real underlying seasoned business behind it. Just makes us wary. And then pandemic darlings. And so it's amazing what we've been through over the past year, how our lives have changed. We used to go out to eat. Now maybe less so now, but a couple months ago, every meal was pretty much being delivered. And whether it was, getting a Domino's pizza, which did, obviously they did very well because they are built on delivery, or you have, DoorDash, which is a delivery company. Or if you're working from home, Zoom, like we're doing right now, or the cleaning supplies companies like Clorox, those became, truly necessities in a time where we were fearful or couldn't leave our homes. But now, as the economy is reopening, we think that it's less likely to see this recurring theme of staying home, getting delivery, getting your Domino's or having DoorDash deliver your food. We think people do want to go back out to eat, and so we think that their go forward revenues will typically or should drop. Clorox, I know my wife was big on stashing Clorox and wipes and hand sanitizer in the basement, but it's probably less likely we have such a the Federal Reserve of Clorox down in our basement on a go forward basis. And so our concern for kind of putting more money into, or more investing money into what worked last year, is that it's not necessarily kind of the what's going to work going forwards. And so lastly, do bonds still have a role to play? That's a question we get a lot. And I think I saw one in the chat about how, why would I hold fixed income if there's a zero interest rates, or if interest rates are so low? And it still holds as the ultimate insurance, really. If the equity markets tend to pull back, and if there's any fear in the equity markets, typically the first place that investors flee to from a safety perspective is high quality fixed income. Last year at one point, some of the high quality fixed income funds were up 10%. You're not going to get that in cash. And when the equity markets are down 20, 30%, it's good to see that maybe a sizable chunk of your portfolio is quite strongly positive. And another thing is there's a worry about rising rates, but there's also a lot of people out there that think yields could decline from here. We might see a short-lived inflation. As Jerome Powell mentioned, he thinks it could be just a temporary pop in the CPI. And if that's the case, they've been very strict on the fact that they want to keep rates lower until we're well through this pandemic. Also, in fixed income, you can get taxed. You can get tax exempt bonds in your taxable account. You can get taxable bonds in your tax exempt account, and that's all a way to make sure that you're optimizing how you're allocating into fixed income. And a bond bear market is typically better than a stock bear market. And by that we mean, a bond bear market, you may not be down the 20%, or you shouldn't. Typically, you're not down 20% like you're down, in a stock bond bear market either. And so, from that perspective, if everything is going down, typically bonds will be down less, and that's where they kind of play into that volatility dampening role in your portfolio. So with that, we'll finish up, and I know we have plenty of questions, and happy to work through those.
And I have to ask to unmute you. There you go, Steve.
Okay, thank you, Paul. David and Fritz, both of you talked about the turnaround in value stocks beginning in the fourth quarter of last year. Looking forward, how much of a bias would you recommend for value stocks versus growth stocks?
Yeah, okay, great question. I mean, basically, we're in the business of capital preservation. We're in the business of making sure people don't lose as opposed to gain. I tell my clients, they bring me 3 million. I say, how much happier would you be if we turned the 3 into 4 versus the 3 became 2 that you would be sad? And I said, Dave, I don't want to see 2. So with that type of thing, where diversification is always number one, and no one has a crystal ball, and so it's always uncertain as to what sector is going to outperform, and therefore we're cautious about any kind of big bets or big overweights or anything like that. Having said that, 2 things. One is we're all value investors. There's no one who would not prefer to pay $95 a share for Apple instead of the current quote of $128, or $150 for Microsoft instead of the current quote of $220. So in some ways, we're always trying to get the best earnings, sales, growth, book value for the least amount of money. So in that sense, the joint growth and value are kind of joined at the hip. Now, having said that, certainly so-called value stocks have been out of favor for about the last decade. They have trailed remarkably. But if you go back over the last 100 years, in point of fact, value stocks have actually outperformed. There's various theories why, but people can tend to overpay for rosy outlooks and then get disappointed. And sometimes, as the old Wall Street saw is, don't tell me what to buy, tell me when to buy it. Buying things when they're out of favor, on sale, tends to be a better strategy. So I think the case for value doing better is it's been under the gun for so long. And of course, if we have a big reopening here, if we have a very strong economy, everybody's got growth. It's not just the people who deliver your pizza or the pizza maker or the people who allow us to do this video conference, but Main Street manufacturers, auto manufacturers, banks, utilities, energy companies, all of those actually should get a big boost for their business. So, I mean, look at energy. How did we all spend Thanksgiving? Doing nothing, having a video conference, not going and seeing our kids or grandkids or going on vacation. What are we going to do next Thanksgiving with any luck? We're going to get the heck out of Dodge, and that's going to require burning fuel. So there's an example of why we think that there's a big wall of demand for traditional value companies. And so I think you can make a big case for tilting that direction. The other big thing is interest rates. So if interest rates go higher, long duration bonds are most adversely affected because their stream of payments goes out for so long. You can analogize that to the stock market. Growth stocks, very little in the way of current dividends or current earnings, but great expectations 5, 10, 15, 20 years down the road. But those are going to get hit harder with higher interest rates because the present valuing of those cash flows are going to take a big knock on them. While companies where a lot of your return, for example, utilities, is up front with maybe a big fat 5% dividend, are going to be less affected by higher interest rates. So bottom line is, if you're optimistic about economic growth, if you believe interest rates are going higher, there is a good case to be made towards shading your portfolio to value stocks. Thank you.
Nolan, you're next.
Okay, I think you helped answer my question with some of your last comments. I was going to start by saying, what's your investment objective? Mine is preservation of capital. You just said your firm is interested in preservation of capital as a core principle. If interest rates are at zero, what is going to happen if inflation and interest rates go up or go up dramatically? Most of us are old enough to remember 1972, when Richard Nixon put in wage and price controls, when we had the incredible rate of 5%. Do you remember? 5%. Oh my God. 4 years later, it was 15%. I'd like you to reemphasize something else you just said about duration. What do you think is going to happen to the value of 30-year bonds versus 10-year bonds versus 10-day bonds if we have an explosion in inflation and interest rates? I think it's easy to predict. So I'm going to announce publicly what I wasn't going to announce. My allocation to bonds is 0.000, as interest rates are close to 0.000. And what I can get on my money, with a lot of money at Fidelity and a lot of money at Schwab, I'm getting 0.01% on my cash. I'd like you to expand further.
Excellent. Well, Nolan, first of all, I'm so glad you didn't ask me a question about U.S. history, because I have fond memories of your great talk to the downtowners. I think it was on was it Jefferson or Hamilton or maybe both? So thank
Hamilton.
God you're not,
It was Hamilton.
challenging me in that
It was
condition.
Hamilton. Jefferson was a financial idiot.
Okay, so in terms of your questions, I think your concern is extremely valid. Obviously, if inflation moves up and interest rates move up, from a mathematical point of view, the present value of everything comes down. You have a home, it rents, you're locked in for a lease for $10,000 a year. That $10,000 in year 2, year 3, year 4 are worth less to you when you present value it. So it's a big, big negative. So why do I not recommend people have the 0% or put all their money in cash or have 0% bonds or do everything with one part of their, do just one thing out of all the choices? A couple of reasons. One is the future is always uncertain. I mean, no one here can, people have talked about higher interest rates in my position for the last decade. It has not happened. And people say they can't go lower. But that's not true. They're below zero in Germany. They're at 1.6% now. So if California fire meets nuclear attack meets North Korea meets pandemic, you can have negative 0.5% yields on the 10-year treasury if necessary by the Federal Reserve. So they could go lower. Second, of course, if you put 0% fixed income, maybe the implication is 100% stocks. We know they can go lower big time. So everyone in stocks has to take into consideration that they could go down by half. Now, fortunately, historically, they've always rebounded, but few people have the stomach to have all of their nest egg go down by 50%, even though they say, well, at least I wasn't in those silly bonds. So that's something to keep in mind. And of course, stocks, a lot of stocks are bond surrogates, your telecoms, your utilities, your REITs. They have very similar low growth properties, constant payouts. They're long duration instruments too. So they could be hit very hard. So I think at the end of the day, your concern is totally valid. I'm just cautious about ever expressing in my portfolio what would appear to be 100% certainty as to anything happening, because I could be wrong. I'd rather be kind of right than totally wrong. Thanks.
Bill Tittle, you're next.
Yeah. What do you say about my aggressive friends that may not be 0% as Nolan, but they're 80-20 into stocks? I'm more conservative and 60-40, and it's costing me a lot. But perhaps over the next 5 years, we'll get back to equity against those 80-20 guys. What's your response?
Yeah, so I would say two things. One is you always need to know your goals. So Peter Lynch, if you haven't read his books, remember he was that famed skipper of the Magellan Fund. He said, you can eat well or you can sleep well. And there's no one right answer to that. And if you have a slight preference to sleeping well, then why take a chance of getting a nightmare in the middle of the night? And so that's the case for the 60-40. Your stomach for volatility, stocks regularly go down to bear market territory. That's down 20%. And over the last decades, we've seen times down, close to 50%. So that's all part of it. Why do I think that most investors with a long-term horizon should tilt towards stocks? Now, you can quibble as to whether it should be 55% versus 80, somewhere in there I'm kind of comfortable with, is because, let's go back to those dividend yields. You got a 1.5% yield on the S&P 500. You got a 1.6% yield on the 10-year treasury. Now, do I want to lock in for 10 years at 1.6%, or tipping my hat to Nolan, realizing what the 70s could do? What's going to happen to the value of the dollar? What's going to happen to corporate earnings? What's going to happen to dividends if we have stronger economic growth and more inflation? I think it's going to go up. So I think today that 1.5% on the S&P 500 could well be 3% by 10 years. In fact, it's kind of likely to do that. So I think after 10 years, you'll have a better total return, both income and capital appreciation with the market, and less exposure to the concerns that Nolan alluded to: inflation, higher interest rates, erosion of purchasing power with the bonds. So, I like the 60-40, the 80-20 is fine. What I don't like to see is people say 25% stock, 75% bonds. I think that's actually the most risky.
More minutes.
Absolutely. And the next question goes to Fritz. He's got the cool idea. So someone give Fritz a question here.
Okay, well, the next questioner is David Ogans. Go ahead, David.
Hi. Yes, I had just read that eventually we are going to have some new tax increases. The two that I'm curious on how it will affect the stock market is, one, the capital gains, which I guess is predicted to go from 20 to 28%, and the corporate gain or new corporate taxes. What do you think these will have an effect on the stock market?
Yeah, so I think the simpler one is the corporate tax change. So certainly, anytime you're reducing the net income, the bottom line on a company's earnings, that's going to impact the what people perceive to be the fair value price of the company. And so we look back to 2017 when the corporate tax rate was reduced. The quote unquote animal spirits took over in the stock market, and the stocks had a record, or a top year that year. I would assume that in a scenario where the corporate tax rates move back up again, they're moving up about from 20 to 28%, so not all the way back to the 35 that they were at. I think you'd see some probably initial volatility, but I think in the long run, I personally, I find it hard to imagine seeing a prolonged recession or a bear market. You might see some sell-off based on the valuation adjustment, but I think then the go forward run rate would the growth really then takes over, and I think that would be kind of back to the market moving up. From a personal standpoint, on the capital gains tax rate change, it could cause some investor behavior to start realizing gains earlier in the year. So if this tax change comes at the end of 2021 to be effective 2022, you might see some people start taking gains on the big high flying stocks. So you might see some selling pressure on the Teslas out there, or stocks that people have had that have done very well over the past decade. Think of the Apple and the Amazons, but I don't necessarily think it's a rotation out of the market. Probably either you'll see a rotation into other areas of the market that might be more attractive, or you could see just the simple wash sale period, or not wash sale period, but someone might sell for a gain and then buy it back either shortly after or in early 2021. And so I think I think there's a lot to be seen, but from a long-term investor's perspective, we necessarily wouldn't change our portfolios so much in anticipation of any major tax law changes.
Okay, thank you. So Larry Cunningham, you're next.
Yeah, I guess the question I wanted to pose is, do you think that the Fed actually has the ability and the smarts to know how to handle an interest rate increase? I mean, if we have an interest rate increase, or sorry, inflation, excuse me, if we have an inflation increase up to from we're at now, I don't know, 1 or 2%, maybe up to 5%. I mean, that would, the PE ratio of the market is related to the interest rate, which is somewhat related to the inflation rate. So I guess two questions. Do you think the Fed can manage that? They got enough tools in their toolbox to deal with all that and do it in a timely fashion? And secondly, if there is inflation creeps up to 3 or 4 or 5, I believe the only thing that works well in that kind of an environment is like gold. Can you comment on that? Those two questions.
Yeah, thanks, Larry, for those questions. So, yeah, I have a degree of skepticism that the Federal Reserve can, in fact, have a long-term effect on interest rates. I mean, basically, classic economics teaches you that ultimately the markets rule, governments don't rule. So it's a little analogous to price controls. How well did price controls work on gasoline in the 1970s? How well did controls on the value of sterling work for Britain in the 1990s and so forth? Ultimately, if there's enough people who go on strike and won't make loans at lower interest rates, those interest rates are moving higher. Of course, you got the political ramifications of it too. if their inflation is a problem, if everyone feels pretty good about the economy, will there be tremendous support for the Federal Reserve to put a stake in the ground to make interest rates artificially low? I'm not sure. I think the smart money now is looking at the fact that Jerome Powell would like to be reappointed for Federal Reserve Chairman for another 4 years, and that could happen in the early part of next year. And but there are elements on the left who are saying he's not doing enough. He's not incorporating social justice sufficiently in terms of his managing of the money supply, and he should be replaced. I think he wants the job, so he's probably more likely to be dovish until then. And after he secures the next 4 years, just like a new president taking office with the mandate, will try and do what's the right thing for the economy, which is probably allow markets to be free, because otherwise you create all sorts of warpage in the economy. If you hold interest rates down too low, it encourages, speculative investing and all sorts of silly stuff. Now, the other question was inflation. Will that be good for gold? Yeah, probably. Certainly it's not good for paper currencies or paper assets. Now, do they go to gold? Well, people who are big proponents of cryptocurrencies says, virtual gold is actually better than physical gold because you don't have to carry it around and so forth. Obviously, it could be good for real estate, stocks, and so, one of the knocks, of course, on gold is as interest rates move up, they say the cost of owning gold is higher because gold doesn't pay any income. But if the reason the interest rates are moving up is because of inflation, that should push up the price of gold. I think on balance, diversification is always key. A little exposure to precious metals in people's portfolio can make a lot of sense.
Thank you. Nolan, you get one more shot, but please make it very short because time is running out.
Okay, I've been unmasked. I've been unmasked. I don't want to be mischaracterized. I never said I'm 100% in cash. Never said I was 100% in cash. You won't love it, but I'm about 25% in the market, and I have 5% in something I may have invented called the catastrophe sector, black swan sector, where I put 5% of my money in things like gold and commodities and volatile things that will explode in the sense of a catastrophe. So that's my actual allocation, 25%, 70%, 5%. And I very much agree with the comment Larry made about gold being a nice place to be in case.
No, Nolan, excuse me, but we're supposed to be asking questions here instead of giving your own philosophy. Our time has run out.
I was mischaracterized, Paul.
Got it. So thank you.
To correct the record.
You have corrected it. Thank you. Thank you.
Okay.
And Mitch, well, I guess you're next. I don't know if you wanted to wrap it up or say something.
Well, my question was, we're looking at infrastructure as being a huge investment, whether the federal government puts in $1 trillion or whatever. And certainly anybody who hangs around here and looks at Jersey Transit and the tunnels and so forth knows that we need more investment in those directions. And similarly, I don't know, in Nebraska. So the question is there a way to invest in infrastructure, or do you go in and pick specific areas like, say, concrete, or do you go in and pick specific companies?
Yeah, so I mean, certainly there are a number of companies from Caterpillar Tractor to Martin Marietta Aggregates and so forth, to other cement and raw material suppliers, to project engineers that one can invest in. I'm sure there's probably some ETFs, exchange traded funds, that have that as a theme. I think the reason why we're not necessarily jumping up and down is two things. One is we may not get that infrastructure bill. And, your comment on looking at local conditions is well taken. That's been the case for the last 10 years. So that's one risk. A lot of people, and certainly if linked to higher taxes, that's going to make it even more difficult. And finally, we often look for themes which haven't necessarily been played out, and a lot of the infrastructure stocks have gone through the roof here. United Rentals was as low as 100 early last year. Now it's approaching 300, and so your observation of the potential has not gone unnoticed. I mean, in an efficient market, for every buyer, there's a seller. And so stocks are pretty fully valued in that area, but certainly I like the theme. Thank you.
Can you hear me now, Paul?
Yes.
Sorry about that. Quick question. Do you invest in individual stocks or do you stick pretty much to ETFs? And the second question is, for a typical client who gives you a pot of money, how much of that, what percentage of that pretty much goes into a couple of broadly based ETFs versus the amount that you actively move around based upon changes in outlook?
Fritz, go for it.
Yeah, no, so we invest, in 99.9% individual stocks. We do not invest in funds. Every once in a while there's we see a closed-end fund that we think is priced attractively. But other than that, our equity portfolios are all individual stocks, which, we think means that, you're not paying, the management fee and then the fund fee. You're getting the exposure to the underlying stocks that you otherwise would be through an ETF. And at the same time, you have the control over, realizing taxes, whether you have a gain or a loss, you can kind of pick and choose, what's being sold. So, we think that, it's a little bit more efficient from, an investing standpoint and a tax standpoint to invest in individual securities.
Thank you. So before we hand it back to Jay for the final ceremony here, I'd just like to make two quick observations. First of all, the follow-up math group actually complements this talk nicely because they're going to be talking about blockchain, which is the underlying mechanism of cryptocurrency. It's full information here, and it was flying by fast. So I think some people might want to go back and review it some. Thank you very much. So with that, I just got a message saying that Jay's having some computer problems, but Jay, if you can do it, we're going to let you do the thanks. Take it away, Jay.
Can you hear me?
Yes.
Okay, Steve Varley's going to take over. I'm about to go black here.
Okay, so Steve Varley.
Yep.
There
he is.
Okay, well, thank you, Paul and Jay, and to David and Fritz. Thank you very much. We heard today a great review of the markets, not only where we are today, but peering into your crystal balls, what's likely to be happening in the future. And at the same time, we also received some very sound recommendations, both opportunities as well as pitfalls in the markets. And we thank you very much. We're very much in your debt. As no doubt David remembers from his prior presentations to the old guard, we have two ways of thanking our speakers. The first way is via a certificate of appreciation, and we have one for both David and for Fritz. You'll both notice the prominent orchid on the lower left-hand side of the certificate of appreciation, and there's a very good reason why that's there. The old guard was founded back in 1930, and at that time, the city of Summit was at the epicenter of the nation's orchid growing and distribution industry. So it was only natural for our founders to choose the orchid as our symbol and as our logo. The second way we have of thanking our speakers is with the old guard salute. And Paul, if you could unmute everyone, we would like to give you that old guard salute.
Go for it.
At this time. Thank you, gentlemen.